What you are witnessing right now is not a normal market move. This is not a healthy pullback. This is not profit-taking. This is what a financial system looks like when it is starved for oxygen. One of the most violent trading sessions in the modern history of precious metals has just unfolded, and if you are staring at your screen, you already feel it in your gut. Red everywhere. Prices collapsing faster than reason can explain. Silver didn't just fall. It was thrown off a cliff. In a single session, over 8% erased a move so aggressive, it forces even seasoned traders to pause and reevaluate their assumptions. Gold followed. And that is the part most people are underestimating. Gold does not behave like this in a functioning market. A 3.5% drop in what is considered the ultimate store of value is not a coincidence. When gold and silver fall together with this level of violence, you are not looking at weakness in metals. You are looking at stress in the plumbing of the financial system itself. This is what happens when liquidity vanishes. In moments like this, institutions stop thinking about value. They stop thinking about long-term theses. They think about one thing only: survival. Bills must be paid. Margin calls must be met. Cash becomes king, not because it is strong, but because it is required. Assets are sold not because they are bad, but because they are liquid. Gold and silver are among the last assets that can still be converted into cash instantly globally at scale. That is why they are hit first and hardest. This is not retail panic. Retail traders do not unload billions in seconds. This is institutional distress. Somewhere in the system, something broke. A leverage position failed. A margin threshold was crossed. And once that happens, the selling is no longer emotional. It is mechanical, relentless, unforgiving. In this emergency analysis, we are not here to tell you to buy. We are not here to tell you to sell. We are here to explain the machine. Because understanding what is happening is the only way to stay rational when volatility is designed to strip that away from you. This is the anatomy of a liquidity event, and it has only just begun. If you want to understand what comes next, you have to understand why this had to happen. To understand why this collapse happened so fast, you need to understand a rule that governs every leverage market on Earth. When margin calls arrive, investors do not sell what they want. They sell what they can. This distinction is everything. It explains why assets with strong fundamentals can fall harder than assets with weak ones, and why logic seems to disappear exactly when you need it most. Imagine a large institutional player. Not a reckless gambler, but a diversified fund with positions across stocks, bonds, currencies, and commodities. Everything looks stable until one corner of the portfolio breaks. Maybe bond yields spike. Maybe a currency trade moves violently. Suddenly the phone rings. The broker is not asking for explanations. They are asking for cash, billions of dollars today. At that moment, theory dies. Long-term outlooks are irrelevant. The fund looks at its holdings and realizes the problem. Bonds cannot be sold without collapsing the price further. Private equity is locked up. Illiquid assets are useless in a crisis. But gold and silver, those trade around the clock, deep markets, global buyers, instant settlement. So the decision is made not because it is smart, but because it is necessary. The sell button gets hit hard. Massive blocks of metal are dumped into the market in seconds. Not to exit a trade, but to raise cash to save everything else. This is why the drop in gold matters more than the drop in silver. Gold is the last line of defense. You only sell it when everything else has failed. Silver, being a smaller and more volatile market, absorbs that shock like a thin sheet of glass. The same force that pushes gold down 3% pushes silver down 8%. This is not a judgment on silver's future. It is a reflection of its role in the liquidity hierarchy. Nothing about industrial demand changed today. Solar panels did not stop being built. Batteries did not stop needing silver. What disappeared was liquidity. And when liquidity disappears, price becomes a casualty. This is how a margin cascade begins, and once it starts, it feeds on itself. In the next chapter, we need to examine why gold selling is the most dangerous signal of all, and what it is quietly telling us about the broader financial system. Silver draws attention because it moves fast, but gold is the signal professionals fear the most. When gold drops sharply in a single session, it is never random. Gold sits at the top of the collateral hierarchy. It is sold only when stress has reached a critical level. A move of this size tells us the problem is systemic, not isolated. Gold is a multi-trillion-dollar market. You do not move it 3% in hours because of opinion. You move it because someone is forced. This is high-quality collateral being liquidated under pressure. It is the sound of leverage snapping. The pressure point is not silver. It is bonds. Bonds are the backbone of the financial system. They secure loans, derivatives, and balance sheets. When bond prices fall and yields spike, collateral values collapse. Banks react instantly. Margin requirements rise. Cash is demanded. If the borrower does not have cash, they sell what they can. And when gold is sold, the algorithms respond. Gold and silver are linked across countless trading systems. When gold breaks, silver is automatically dragged lower. This has nothing to do with industrial demand. It is a mechanical contagion. This is why today feels unjust to metal holders. You can be right on fundamentals and still suffer from a failure elsewhere in the system, but there is a crucial lesson here. Liquidity crises cannot persist. The system is too leveraged. Every modern crisis ends the same way intervention. Liquidity is injected, dollars return, and the assets sold hardest are the first to rebound. We are still in the shock phase. Fear dominates, but this phase always passes. Next, we need to examine how algorithmic trading accelerates these collapses and why prices often fall far below reality before stabilizing. Modern markets are no longer driven by humans. They are driven by code. And when volatility reaches a certain threshold, that code becomes the accelerant that turns a sell-off into a freefall. What you witnessed today was not panic selling. It was algorithmic liquidation. For weeks, the trend in silver was up. Trend-following funds, CTAs, and momentum models were heavily long. These systems do not analyze supply shortages or industrial demand. They follow price volatility and moving averages. As long as the trend holds, they buy. They amplify upside. But today the structure broke. The drop was sharp enough to trigger short-term trend reversals. In minutes, models flipped from long to neutral, and in some cases from neutral to short. Billions of dollars in paper contracts were dumped automatically. No emotion, no discretion, just execution. This is why price often overshoots during liquidity events. The algorithms do not know silver is scarce. They do not know premiums are rising. They only know a line on a chart was crossed. This creates forced selling far below fair value. Humans trade reality. Algorithms trade math. In the short term, math has more money. That is why these moves feel violent and irrational, but this imbalance also plants the seeds of the reversal. As price collapses, physical buyers step in, arbitrage appears. The gap between paper price and real-world demand widens. This is where the algorithm loses its edge. It cannot see the physical floor forming underneath the market. The crash cleans out leverage. It removes weak hands. It resets positioning. This is painful, but it is also necessary. Before a trend can continue, excess must be purged. In the next chapter, we will examine the physical market response premiums and why paper price collapses often fail to reflect real-world scarcity. One of the most misunderstood aspects of this crash is the illusion of price. What you see on the screen is not the price of silver in the real world. It is the price of a paper contract being liquidated by a distressed system. And during liquidity events, the paper market and the physical market begin to separate. When futures contracts are dumped in size, spot price collapses instantly. But physical metal does not move at the speed of an algorithm. Coins bars and industrial supply chains operate in the real world with inventory constraints, transport delays, and fabrication costs. These realities do not disappear just because a hedge fund needed cash. This is why premiums matter more than spot during moments like this. When spot drops 8%, but dealer premiums barely move, the market is sending a message. Physical supply is tight. Dealers cannot restock at the paper price. Refiners are charging more, not less. The spread widens. In a healthy market, premiums compress. In a stressed market, they expand. A wide premium is a symptom of a broken pricing mechanism. It tells you the futures market is disconnected from physical reality. Paper is being sold faster than metal can be sourced. This divergence is not bearish. It is structural. It signals that forced sellers are being absorbed by long-term holders and industrial buyers. The weaker the paper price becomes relative to physical demand, the stronger the rebound potential grows. If you hold physical metal, nothing fundamental has changed. You do not face a margin call. You are not forced to act. Time is on your side. The distressed seller must transact now. You do not. In the next chapter, we will look at historical liquidity crises and what happens after forced liquidation ends, using past examples to frame what may come next. Liquidity crises feel unique when you are inside them, but history shows they follow a familiar script. The trigger changes, the numbers grow larger, but the mechanics remain the same. Forced selling creates extreme dislocations, and once that pressure exhausts itself, the rebound is often violent. In March of 2020, silver collapsed nearly 30% in a matter of days, not because demand vanished, but because the world needed dollars. Hedge funds sold silver to cover losses in equities and bonds. At the bottom, sentiment was apocalyptic. Yet within months, silver more than doubled as liquidity flooded back into the system. The same pattern appeared in 2008. Gold and silver were sold to raise cash even as the financial system was cracking. Once central banks intervened, those same assets became the primary beneficiaries of monetary expansion. Liquidity crises end not with stability, but with stimulus. This is why the most dangerous moment is not the top, but the middle of the crash. This is where investors abandon sound positions out of fear. They sell real assets to hold temporary safety. When liquidity returns, they are left behind. History does not promise immediate relief. Volatility clusters. Big moves are often followed by more big moves, but history does offer perspective. These events are sharp and short-lived because prolonged deflation would collapse the debt-based system itself. The market is not questioning silver's usefulness, it is demanding cash. Once that demand is met, the focus shifts back to fundamentals, and fundamentals do not reset in a single session. In the next chapter, we will examine where the market may attempt to find a floor and which levels matter most for determining whether this is a correction or something more. After a move this violent, the most important question becomes unavoidable. Where does the selling actually stop? In a normal market, value creates support. In a liquidity event, support appears only when forced sellers are exhausted and real buyers finally step in. The chart is damaged, but it is not useless. The first critical zone is psychological. Round levels matter because both humans and algorithms react to them. For silver, this area aligns with the prior breakout zone where momentum first accelerated and where demand previously proved itself. Markets often return to these levels to test whether conviction still exists. If price stabilizes here, it suggests the crash was a purge, not a failure. A violent retest after a breakout is terrifying but technically healthy. It clears leverage, resets sentiment, and forces the market to rebuild on stronger hands. If that level fails, the next support lies deeper, near the origin of the prior rally. A move there would feel catastrophic emotionally, but in highly volatile commodities, deep retracements are not abnormal. They are part of the cost of participating in markets that overshoot in both directions. What matters most is not the lowest print, but behavior around support. Rising volume on stabilization, slowing downside momentum, and price acceptance signal that real money is stepping in. Continued silence from buyers signals that the liquidation is not finished. At the same time, physical demand acts as an invisible floor. As price drops, arbitrage opportunities grow. The gap between global demand and paper pricing tightens like a stretched cord. Eventually, that tension snaps back. Next, we need to examine how miners and equities respond to this stress, and why stock price collapses often misrepresent underlying profitability. When silver drops sharply, mining stocks almost always fall harder. This is where many investors panic, because equity prices feel more permanent than commodity moves. A 10 to 15% decline in miners looks like a verdict, but price action and business reality are not the same thing, especially during liquidity events. Mining stocks are leveraged instruments. They amplify both upside and downside. When silver rises, margins expand quickly. When silver falls, fear expands even faster. Investors sell miners not because the companies are failing, but because they are selling everything that carries risk. This is indiscriminate liquidation. Step back from the chart and look at the numbers. Even at significantly lower silver prices, most primary producers remain highly profitable. Their cost structures do not change overnight. Energy contracts, labor agreements, and capital investments are fixed on longer timelines. A one-day price collapse does not erase operating margins. Yet the stock market prices these companies as if the commodity collapse is permanent. This creates a disconnect. Earnings power remains intact while equity prices implode. That gap is not sustainable. Liquidity-driven sell-offs punish miners more than the metal itself, because stocks are easier to dump. But once selling pressure fades, equities tend to rebound faster. Investors rediscover cash flow. Valuations compress into absurd territory. Value investors step in not because sentiment has improved, but because math demands it. This is where patience becomes an edge. Those who survive the flush benefit from the re-rating that follows. Those who sell at the point of maximum stress lock in losses while institutions prepare to accumulate. In the next chapter, we will examine the macro timeline, how long liquidity crises typically last, and why calendar effects often mark the turning point. Liquidity crises are violent, but they are rarely long-lived. The system simply cannot tolerate extended deflation. Debt requires rising asset values to remain serviceable, and when those values fall too far, intervention becomes inevitable. This is why time matters as much as price during moments like this. Historically, the acute phase of liquidity stress lasts days or weeks, not months. In 2008, the most intense selling occurred over a short window before policy responses escalated. In 2020, the crash unfolded rapidly and reversed just as quickly once liquidity was restored. These events feel endless while they are happening, but they are compressed in hindsight. The calendar plays a quiet but powerful role. End-of-year trading distorts behavior. Funds harvest tax losses. Risk is reduced. Liquidity thins out. This exaggerates moves in both directions. Once the calendar flips, those artificial pressures disappear. Sellers step away. Buyers return. January is historically a reset point. Capital that was sidelined re-enters the market. Allocations are refreshed. Pullbacks that looked terrifying in December suddenly look like opportunity. This is why crashes near year-end often become the foundation for early year rallies. Psychology reinforces this shift. Fear peaks after damage is done, not before. When sentiment flips from euphoria to despair in a matter of days, the market is already closer to a low than a high. Most participants react late. The market anticipates. We are approaching that inflection window. Price alone will not signal it. Behavior will. Reduced volatility, stabilization, and selective buying are the clues. The final chapter will bring this together, outlining the strategic lessons, risk management principles, and the mindset required to navigate what comes next. We have now dissected this event from every angle. The mechanics of forced liquidation, the role of gold as collateral, the algorithmic cascade, the divergence between paper price and physical reality. What remains is the lesson, because every liquidity crisis leaves one behind. The market did not fail today. It revealed itself. Leverage was exposed. Excess was removed. Sentiment was reset. This was not the end of a trend, but a stress test of conviction. Those who were overextended were removed. Those who relied on borrowed time were forced out. The strategic takeaway is simple but unforgiving. Survival comes first. Leverage is the enemy in volatile markets. If you own real assets without margin, time is your ally. If you rely on borrowed money, time works against you. Liquidity events do not reward intelligence. They reward positioning. The second lesson is patience. Markets that fall the hardest in liquidity crises are often the same markets that lead the recovery. Once intervention begins and cash returns, capital flows back into assets that were unfairly punished. This is not optimism, it is pattern recognition. The third lesson is psychological discipline. The greatest damage is rarely financial. It is emotional. Anchoring to recent highs, reacting to fear, and confusing volatility with failure are how investors destroy long-term outcomes. The trend matters more than the day. What comes next will not be smooth. Volatility will persist, tests will occur, but liquidity always returns. When it does, the narrative changes fast. Fear becomes disbelief. Disbelief becomes participation. Participation becomes excess. The cycle repeats. Your role is not to predict every move. It is to remain solvent, rational, and prepared. This event did not invalidate the long-term thesis, it reinforced it. If this analysis helped you stay grounded, take a moment to support the channel. Type 1 in the comments if you're still holding through the volatility. Type 2 if you're watching from the sidelines. Subscribe, share this breakdown, and stay focused. The market will move on. Those who understand it will move with it.